The precious metals sector just experienced one of the most violent reversals in market history, and what happened over the past 2 weeks will be studied for decades. I'm going to break down exactly what occurred, why it happened, and most importantly, what comes next for silver, platinum, and palladium. Here are the staggering numbers. Silver broke above $100 per ounce for the first time ever, a generational milestone. Then, within roughly 10 days, it crashed by approximately 33%. One-third of its value evaporated in less than 2 weeks. Gold recorded its sharpest decline in nearly 4 decades. These are moves that most traders have never experienced in their entire careers. Silver had actually been the best-performing asset class last year, outpacing stocks, bonds, and crypto. Now everyone's wondering if that run is over, or if this crash represents something else entirely. Before we dive deeper, drop a comment telling me where you're watching from and your strategy. Did you buy silver before the crash? Are you buying now? Or are you waiting for lower prices? I read every comment, and your perspectives shape our conversations here. Let me also be crystal clear about something important. I don't sell courses, trading signals, or memberships. What I share is raw analysis presenting both sides, so you can make your own informed decisions. If anyone claims to represent this channel, block them immediately. Scammers are everywhere. Now let's get into what actually happened. The crash was triggered by a perfect storm of factors. We had a sharp dollar rebound combined with shifting Federal Reserve expectations and aggressive position unwinding. Specifically, easing tensions between Washington and Throne reduced safe haven premiums. Progress in tariff negotiations and reduced risk of a U.S. government shutdown calmed markets. Kevin Walsh's nomination as the next Fed chair prompted traders to scale back aggressive rate cut expectations. Walsh is perceived as more hawkish, which typically pressures non-yielding assets like gold and silver. But what made this sell-off particularly brutal was the technical amplification. Heavy call option positioning meant that as prices fell, dealers had to sell to hedge their positions, creating more selling pressure. Margin calls forced leverage traders to liquidate whether they wanted to or not. Speculative liquidation cascaded through the market. Manav Modi at Motilal Oswal described it perfectly. The unwind was severe, amplified by heavy call option positioning, margin calls, and speculative-driven liquidation. In international markets, gold dropped to around $2,400 per ounce, before recovering to around $2,900, a swing of roughly $500 or about 15%. Silver plunged from its all-time high around $121 per ounce to a low around $64, a collapse of nearly 50% in days. Despite the steep sell-off, signs of stabilization emerged as forced liquidation eased and value buying returned. The panic selling created opportunities for those with cash and conviction. A sharp rebound followed the lows, aided by weaker economic data and value buying after the correction. Physical demand from China ahead of Lunar New Year has remained resilient. So the critical question everyone's asking, was that the bottom, or is more pain coming? Let me present both sides because that's what we do here. First, the long-term case for precious metals remains intact, despite the short-term carnage. The supply and demand fundamentals haven't changed, and this is critical. Silver has been in a supply deficit for 5 consecutive years. Platinum has been in deficit for 3 consecutive years. A supply deficit means demand exceeds annual mine production, so markets are drawing down existing inventories. This cannot continue indefinitely. Robert Minter at ABRDN Investments made an important point about what makes this cycle different. The last major commodity cycle from 2000 to 2015 was driven by China's growth and demand. This cycle is characterized by a dearth of supply, not just strong demand. Here's the key data point. According to S&P Global, the average mine takes more than 15 years to develop from discovery to production. Even if silver prices stayed at $100 permanently, it would take 15 years before significant new supply could come online. Minter explained that cycles are very long in commodities, and justified because it's hard for high prices to cause additional supply. It takes so long. But it gets even more constrained. Even increasing production from existing mines is difficult. There are only a few pure silver mines globally, Much silver, platinum, and palladium production comes as a byproduct of base metals like copper or lead. Base metals miners are unlikely to focus on increasing precious metals output at their main ore body's expense. Additionally, platinum and palladium deposits are concentrated mostly in Russia, which presents geopolitical issues, and South Africa, where aging infrastructure and energy costs create constant challenges. New supply takes 15+ years, existing supply is difficult to expand, and geographic concentration creates risks. This is the fundamental backdrop supporting higher prices long-term. Demand is equally important. Silver is what analysts call a chameleon with dual characteristics. Sometimes it acts like gold, following safe haven flows during geopolitical uncertainty. Other times it acts like an industrial metal, driven by manufacturing and technology demand. Industrial demand continues growing. Silver is used in electronics, solar panels, electrical infrastructure, and increasingly in AI semiconductor chips. As the world electrifies and builds renewable energy capacity, silver demand grows. These are secular trends that don't reverse because of a 2-week correction. Platinum and palladium are key components of catalytic converters, and while EV transition might reduce this demand, the timeline is measured in decades. Central banks continue buying gold at record paces, ETF investors keep adding holdings, and even crypto firms have increased buying. The demand side remains robust. But I promised both sides, so here are the reasons for caution. First, after a 150% run in silver, even the most bullish analysts are cautious about adding at current levels. Robert Minter specifically said a reasonable person after a 150% run would say this is maybe not the place to add. Second, volatility is likely to remain elevated. These markets are smaller than gold and prone to greater price swings. Third, the recent price action demonstrated how quickly gains can evaporate. A 33% decline in 10 days isn't normal behavior. It's volatility that can destroy portfolios if position sizing is wrong. Fourth, short-term headwinds remain. The Fed's policy path is uncertain, the dollar could strengthen further, and risk sentiment could shift. Pranav Mehr at JM Financial Services summarized it well. While gold's bias remains positive, for silver they remain cautious of volatility and further corrections. So where does that leave us? Let me share what professional wealth advisors are actually doing with client portfolios. Financial advisors who incorporate precious metals generally recommend gold as the foundation, comprising at least 50% of the precious metals allocation. Silver, platinum, and palladium are added in smaller amounts depending on risk tolerance. Most advisors recommend limiting total precious metals to about 5% of the entire portfolio. Gabriel Shaheen, CEO of Falcon Wealth Partners, shared his specific allocation. He uses precious metals as an uncorrelated asset for clients with $5 million or more as a hedge against market risk, currency risks, and inflation. His strategic allocation ranges from 1 to 5% of total portfolio. Within that precious metals allocation, he typically puts 50% to gold, 30% to silver, and 10% each to platinum and palladium. Let me repeat that because it's instructive. 50% gold, 30% silver, 10% platinum, 10% palladium. Gold is the anchor. Silver provides additional upside with higher volatility, and platinum and palladium add diversification. Jonathan Harrison at Sound Stewardship noted that precious metals appeal most to his conservative clients looking for balanced approaches rather than growth. The metals serve a defensive purpose, not speculative. Rebalancing is particularly important with these volatile assets. Some advisors will let a position rise to 7 or 8% before taking profits, or buy dips to right-size holdings if prices fall below target allocation. David Rosenstock at Wharton Wealth Planning emphasized that rebalancing and maintaining discipline is important because of the role these metals play. Most advisors use ETFs for convenience and liquidity, though some clients choose physical metals for peace of mind. Some investors consider mining stocks for leveraged exposure, but it's tricky for silver, platinum, and palladium. There are fewer pure-play silver miners, and platinum and palladium producers face challenges in South Africa with energy costs, labor issues, and infrastructure problems. Thomas Christopoulos, portfolio manager of First Eagle Gold Fund, offered this perspective. All things being equal, Owning bullion is preferable to mining stocks because miners face engineering, geological, geopolitical, and financial challenges that make it a very tough business for non-experts. Let me ask you, how are you positioned right now? Are you holding physical metal, ETFs, mining stocks, or some combination? What percentage of your portfolio is allocated to metals? Drop a comment and share your approach. Now, what we're watching near term. Traders will monitor US GDP, PMI, non-farm payrolls, and inflation data influencing Fed policy expectations. Inflation readings from China, Germany, and India will be watched closely. Fed officials' speeches will be tracked for rate cut timing indications. The relationship between interest rates and precious metals is important. Gold and silver don't pay interest, so when rates rise, the opportunity cost of holding metals increases. When rates fall, that cost decreases and metals become more attractive. Walsh's nomination has created uncertainty. Markets had priced in aggressive cuts, but are now reconsidering. This contributed to the sell-off, but could reverse if economic data disappoints. Physical demand from China ahead of Lunar New Year remains resilient. This matters because China is one of the world's largest precious metals consumers. Strong physical demand can provide a price floor even when paper markets are volatile. Analysts believe broader fundamentals still support bullion through 2026, driven by central bank buying, fiscal concerns, and geopolitical risks, though near-term volatility will likely stay elevated. Here are the specific levels that matter. Gold has recovered to around $2,900 after falling to around $2,400. Support around $2,400 to $2,500 appears significant. Resistance around $3,000 remains the ceiling. Silver remains more volatile. After crashing from around $121 to around $64, it's bounced but stays under pressure. The range between $64 and $80 appears to be the current trading zone. A sustained move above $85 would suggest the correction is complete. A break below $64 would indicate more downside ahead. Let me address the psychological aspect because it's important. A 33% crash in 10 days is emotionally devastating if you were heavily positioned. Some of you experienced significant losses, some panicked and sold at the lows, and some are now wondering whether to re-enter. Here's my perspective on navigating this volatility. First, position sizing is everything. If you can't handle a 30 to 50% drawdown, you're too heavily positioned. The appropriate size lets you sleep at night and maintain rational decisions during extreme volatility. For most people, that means keeping precious metals as a portfolio minority. Second, know your time horizon. If you're trading short-term, this volatility could have been profitable or devastating depending on timing. If you're investing long-term on fundamental supply-demand dynamics, short-term price is almost irrelevant. The question is whether your thesis remains intact. Based on everything shared today, the supply deficit story hasn't changed. Third, have a plan before volatility hits. Decide in advance at what levels you'll buy more, take profits, or cut losses. Making these decisions in the heat of the moment destroys traders. Fourth, understand that volatility is the price of admission for potentially higher returns. Silver's volatility enables larger percentage gains during bull markets, but also larger losses during corrections. Let me synthesize everything into actionable perspective. The fundamental case remains intact. Supply deficits persist. New supply takes 15+ years to develop. Industrial demand continues growing. Central banks keep accumulating. And geopolitical uncertainty hasn't disappeared. The short-term picture is more complicated. Volatility will likely remain elevated. Technical damage will take time to repair. Fed policy uncertainty creates headwinds, and additional unwinding could trigger further selling. The professional approach based on wealth advisor guidance is maintaining disciplined allocation as part of diversified portfolios. Gold is foundation, silver for additional upside, platinum and palladium for diversification. Total allocation in single digits as portfolio percentage, and regular rebalancing. For aggressive investors, the crash may represent a buying opportunity since fundamentals haven't changed and prices are significantly lower. But this requires conviction and capacity to withstand further volatility. For cautious investors, waiting for further confirmation makes sense. Let markets prove selling is exhausted. The cost is potentially missing upside. The benefit is avoiding further downside. There's no single right answer. Your approach should depend on your financial situation, risk tolerance, time horizon, and conviction. Here are my key takeaways. 1. Silver experienced a historic 33% crash after reaching all-time highs above $100, and gold recorded its sharpest decline in nearly 4 decades, driven by dollar strength, Fed policy expectations, margin calls, and speculative liquidation. 2. Fundamental supply-demand hasn't changed. Silver has been in deficit for 5 consecutive years, platinum for 3 consecutive years, and new mine supply takes 15+ years to develop, supporting higher prices long-term. 3. Professional advisors recommend gold as at least 50% of precious metals allocation, with silver, platinum, and palladium in smaller amounts, limiting total metals to about 5% of portfolio with regular rebalancing. 4. Volatility will likely remain elevated near-term. Traders should watch key economic data and Fed commentary, while recognizing that physical demand from markets like China provides support, but may not prevent paper market volatility. 5. Position sizing and time horizon are critical. The crash showed gains evaporate quickly, so only position in sizes allowing rational decision-making during extreme volatility. Thank you for being part of this community. We're growing because people want honest, balanced analysis rather than hype. If this helped you understand what happened and what might come next, share it with someone who needs this perspective. Subscribe so you don't miss the next critical update. Drop a comment with your outlook. Do you think the bottom is in? Are you buying, holding, or selling? What's your allocation strategy? Remember, invest with logic, not emotion. Do your own research, understand both sides, have a clear plan, and know your time horizon. Never follow anyone blindly, including me. The best investors think independently and take responsibility for their decisions. The precious metals market just experienced something historic. Whether this crash marks the end of the bull market or merely a violent correction within an ongoing uptrend will become clear in the weeks and months ahead. How you position yourself now could determine your financial outcomes for years to come. Stay sharp, watch the data, maintain discipline, and I'll see you in the next video.